It's not a surprise to muddle through a windy and wet day at this time of year, but the central bank's decision to relax its mortgage rules certainly surprised many. The rules were introduced in 2015 to prevent a repeat of the lending practices which contributed to the property crash. The changes announced today enable a first-time buyer to go from borrowing a maximum of 3.5 times income to 4 times their income. They will still need a deposit equal to a minimum of 10% of the value of a property. Second-time buyers will still only be able to borrow up to 3.5 times salary, but they will now only need a 10% deposit to trade up. The changes kick in from January the 1st. The bank maintains its rules have worked well, reducing indebtedness and improving bank balance sheets. So why change them?
We're not going back to a world of reckless lending and reckless borrowing through this change. I think it's a calibrated change. It's been well considered. It is worth saying, just emphasising, that the mortgage measures are not about and cannot control house prices. Ultimately, that is about supply.
The Governor admits the changes will lead to a modest increase in house prices, but he expects the slowdown in the economy and the prospect of higher interest rates will mitigate against that. Ultimately, the bank sees the rules as so-called guardrails and expects banks and buyers to continue to borrow prudently. Robert Short, RTE News.